Welcome to Virtual Wisdom Finance and Accounting Tutorials. My name is Peter and I'll be your host in this particular tutorial. Today, I want us to look at CashBook and Bank Reconciliation Statement. This is a topic in financial accounting, and for us to understand the CashBook and Bank Reconciliation Statement, we first of all need to understand a few terms. One, we need to understand what a cash book is. So a cash book is a summary of cash and bank transactions. At one given point, every organization will have a bank account with a given financial institution, that is a bank. And when you have an account with a bank, you need to maintain what we call a cash book, so that you are able to record any monies that you receive and any monies that you give out or that you pay. When you receive funds, you're supposed to debit your cash book. That money that you receive, maybe from your supplier, from your customers, from your debtors, that is account, receivables, etc. When you debit your cash book, then you take that money to the bank. The bank on the other side is going to maintain what we call a bank statement. In the bank statement, they're going to do the opposite. When you receive funds and when you deposit to the bank is going to credit your account. The reason why the bank credits your account is because this money that they are receiving is not their money. It is your money, and you can demand or you can request for it at any time that you want it. And because it is not money for them, that is why they are crediting, because it is a liability they have. You can request for your money at any given time. On the other side, when you withdraw money from your account, maybe to pay your suppliers, to pay your creditors, you are going to credit your cash book because you are spending. On the other side, the bank is going to debit the bank statement. Why? Because they are reducing the liability they have for you. If, for example, you had in your bank account 50,000, and then you have withdrawn 10,000. It simply means the liability that they had for you of 50,000 has reduced by 10 to 40,000. So you find that these two statements, the cash book, which is maintained by the firm, and the bank statement, which is maintained by the bank, they are supposed to have a similar balancing figure. That is, the balance carried down by the firm in the cash book and the balance carried down by the bank in the bank statement should be the same. They are supposed to be the same in the normal circumstances. But you find that in most of the situations, or in most of the times, these two accounts are never showing a similar balance. You find the bank account, the cash book, having a different figure from the bank statement that is maintained by the bank. And now that brings about what we call a bank reconciliation statement. A bank reconciliation statement is a statement that is supposed to explain the difference between the balance at bank and the balance in the balance at bank as per the cash book and the balance at bank as per the bank statement. Remember, these two, the cash book and the bank statement, are both of them giving transactions or giving a summary of transactions in the bank. So you find that a cash book might be having a closing balance of 20,000 and the bank statement is having a closing balance of 50,000. So to explain why these two are having a difference, that is why we normally prepare what we call a bank reconciliation statement. There are various factors that lead to the difference in balances between the cash book and the bank statement. And some of these factors include, let's start with the factors in the bank statement. In the bank statement, we might have items that appear in the cash book and are not reflected in the bank statement. These items include, one, unpresented checks. Unpresented checks, these are checks that you write to your creditors or to your suppliers, but these people fail to take them to the bank within the given duration. For example, if you write a check to your creditor or to your account payable on 29th of December. Then on 30th, you go ahead and prepare your financial statements. Then this creditor takes that check to the bank on 31st of that month. It means the bank statement that you used on 30th did not take into consideration the check that was taken a day later. But this check was actually written earlier, but it was delayed to be taken to the bank. So in the cash book, this check is going to be taken into consideration, but in the bank statement, this check will be missing, and that's what that is what we are calling what? Unpresented checks. You have written them, or maybe the creditor or the supplier has already taken that check to the bank, but because maybe the workers at the bank have a lot of work to do, or maybe it was a holiday, they have not yet deducted funds from your account, and therefore it will end up being what? An unpresented check. On the other side, we have what we call uncredited deposits or checks. You have received a check from your customer or from a debtors, that is account receivables. You have debited, because when you receive funds, you're supposed to debit the cash book. You have debited the cash book, and then you need to take this check to the bank so that the bank can credit your account, that they can deduct money from your customer's account and put it in your farm account or in your business account. So if the bank delays in deducting or in putting funds into your account, that is in crediting your account, then in the cash book, this check will be taken into consideration, but in the bank statement, it will not be taken into the consideration. So during this duration where the check is yet to be credited, if you prepare your financial statement, then it means there will be a difference between the bank and the cash book that is maintained by the firm and the bank statement that is maintained by the bank. The other thing, we have some errors or transactions on the bank statement that have an effect of increasing the balance at bank. On the other side, we also have errors or transactions on the bank statement that have an effect of decreasing the balance at bank. Let's start with those errors that have an effect of increasing the balance at bank. One is automatic deposits. You have a customer, you have an account receivable. Instead of this customer paying that money to you, they go and deposit the money directly into your bank account without your knowledge, and they continue their business. So when you're preparing your financial statement, you will not take into consideration of that amount because you are not aware that that amount has been deposited. So what will happen is you're going to prepare your cash book, but on the other side, on the credit side of the bank statement, this amount will be included because the bank will have credited, but in your cash book it will be missing, and therefore there'll be a difference. The other thing is interest earned. At times you have some money in your savings account. This money earns interest. If the interest is released and it is credited into your account without your knowledge, again, when you're preparing the cash book, you have not taken into consideration of the interest, but in the bank statement it has actually been included. The other thing is overstatement. Overstatement is when a figure that is entered into the bank statement is bigger or it's more than what is actually supposed to be entered. Maybe you went and made a deposit of 20,000, but in the bank, the person preparing the bank statement enters 200,000 instead of 20,000. They have increased the figure by to 200,000 from 20,000. That will again have an impact on the final figures. Let's look at some of the errors with the effect of decreasing the balance at bank. One is deposit in transit. Deposit in transit, this is where, so you find that during the normal business time, when you make sales, you deposit funds based on how the sales are coming in, maybe at the end of the day, maybe at the middle of the day, etc. So if it happens that you deposit at the end of the day, then during the day you prepare the financial statement. Maybe that was the day for preparing the financial statement. You have already included that you have deposited 20,000 into your bank account, but this money have just been released from your farm going to the bank. They have not reached the bank. So if you prepare the financial statement at that time, the bank will not have taken into consideration the 20,000 that is on the way to the bank, and that is what you are calling what? Deposits in transit. Automatic withdrawals. For example, standing orders. You have ordered your bank to be paying your employees on your behalf. So at times they pay your employees and you're not aware that they have actually paid. So you go ahead and prepare your financial statements. You have not included the salaries, but on the other side, the bank has already paid and they have included. Maybe you are paying a loan and the bank is deducting money from your account and paying the loan on your behalf. That is a standing order. And that particular case, they have deducted, but you're not aware. So when you are preparing your cash book, you'll not take into consideration of the automatic withdrawal. The other thing is the bank service charges. You go to your bank, you withdraw 20,000. Maybe you are charged 100 shillings to withdraw 20,000. When you go to your cash book, you record that you made a withdrawal. So you're going to credit the cash book with 20,000. You fail to record the 100 shillings that you spent, the cost of the transaction. You didn't include it, but in the bank they're going to include the 20,000 that you withdrew plus 100 shillings that was charged, and therefore that 100 is going to cause a difference. You also have an understatement. Understatement is when the figure that is entered is lesser than the actual figure that is supposed to be entered. You go to the bank, deposit 200,000, but what is entered in the bank is 20,000. So you find that the figure will be less. It will be 20 instead of 200,000. Those are some of the errors or some of the transactions that may have an effect on the bank balance. Let's look at some of the errors that may take place in the cash book. What are some of the errors that you can end up committing when you're preparing the cash book? The first error here is over or understated payments. Again, like we have said, you can overstate the figures, you can understate the figures. Then we have over or understated deposits. You might state more than what you actually deposited. You deposited 20,000, but you overstate it in your cash book. Instead of 20, you write 200,000 the same way. Then we have misposted deposits and payment. You made a deposit. A deposit is supposed to be debited in the cash book, but instead of debited, you went ahead and credited the cash book. That is a misposted deposit. Then we have overcasting and undercasting of the balance carried down. So you have a balance carried down of 20,000, and instead of writing 20,000, you write 200,000. That means you have overcasted the balance carried down. The balance carried down is the balancing figure in your accounts. So those are some of the errors that may lead to the difference. Now, after understanding that, let's look at some steps in preparing a bank reconciliation statement. We have 4 key steps that if you follow them keenly, you will prepare your bank reconciliation statement with ease. Step number 1, update the cash book. What we mean by this, we have those items that are in the bank statement but are missing in the cash book. Identify them and put them in the cash book. When you put them in the cash book, you will have updated the cash book. Step number 2, compare the debit side of the cash book and the credit side of the bank statement. Why do we compare that? Debit side of the cash book records money that is received or deposits to the bank. When you take money to the bank, when you receive money from your customers, you debit your cash book. You take it to the bank is going to credit your cash book. So the reason why you're comparing these two, you need to check if there is an item that is on the debit side of the cash book and it is missing on the credit side of the bank statement. That is what we refer to as uncredited deposit or a check. You have deposited a check, but that check is yet to be taken care of at the bank. That is an accredited deposit. Step number 3, compare the credit side of the cash book and the debit side of the bank statement. The reason why you compare these, credit side of the cash book is going to record withdrawals or payments. If you make payments to your creditors, if you make payments to your suppliers, you credit your cash book. On the debit side of the bank statement, when you make these withdrawals to go and pay, then the bank is going to debit your cash book. And if we have items on the credit side of the cash book and are missing on the debit side of the bank statement, that is what we call the unpresented checks. I've already explained what they are. These are checks you have given to your creditors or suppliers, but they are yet to take them to the bank for the account to be reduced, or for the bank to deduct money from your account. Once you're done with correcting this, once you have updated your cash book, you have checked for uncredited deposits, and you have checked for unpresented checks, then you go ahead and prepare the bank reconciliation statement. And the bank reconciliation statement is going to show unpresented checks, uncredited deposits, and any errors on the bank statement, and it's also going to show the updated cash book balance. Having looked at that, let's go through a bank reconciliation statement format, and this format is based on the 4 key steps that I have shown you on preparing the bank reconciliation statement. So we have said step 1, update the cash book. Once you update the cash book, get the updated figure. Then on the updated figure, you're going to add unpresented checks. Where do we add them? Unpresented checks, these are checks you have written to your creditors or your suppliers. When you wrote them, you credited your cash book. And because they have not been taken into consideration in the bank statement, it's like you're getting them back. That's where you are adding them, so that your balance in the cash book can be in line with the bank statement. Because they have not been taken care in the bank statement, you also take them back, so that you are going to cancel the credit that you had made before. Then on that, you also add any errors or any transaction on the bank statement that will have an effect of increasing the balance at the bank. So when you add these two, get the total here. So a single line in accounting here, like this one here, means addition. So you add these two, get the total there. Then you less uncredited deposits and those errors with the effect of decreasing the balance at bank. So you add these two. So these two you are subtracting. So when you put them in bracket, a bracket means subtraction. So this is the total here. So when you take the balance as per updated cash book, you add this minus that. Whatever is going to remain here will be the balance at bank as per the bank statement. So at this particular point, you'll have explained why your cash book is having a different balance with that of the bank statement. We are going to see this clearly in an illustration that we are going to look at next. Illustration. On 10th January 2006, Joseph, a sole trader, received his monthly bank statement for December 2005. The statement showed the following. So ignore this, not part of the question. Can ignore that. So you're given the bank statement here. So as at December 1st, the balance, that is the balance at the bank, was 186,200. Then on date 5 of December 5th, there is a check here that was written for electricity. So we don't know whether it was an expense or it was an income. So you need to check where does it fall. It is on the debit. And we said on the debit, the bank will debit the bank statement when a withdrawal is made. And therefore, the electricity here is an expense. So it is going to reduce the balance at the bank. So you minus this to get what? 161,900. Then you go to date 5. There is dividend. Is it an income or an expense? Again, it is credited, meaning it is an income. So it is going to increase. So you add 2,600 to get 164,500. You add 21,200 to get 185,700. Then you minus 174, that is 17,400 to get 168,300, etc., etc., to the last transactions. It continues to this end. So you do the same until you get the balance. So as at 30th December, the closing balance as per the bank statement was what? 155,700. This means if the cash book will have a similar balance, that is 155,700, then there will be no need of preparing a bank reconciliation statement, because what will you be reconciling? But if the cash book is going to have a different figure, then we have to explain where those differences are coming from. And how do we explain that? Through what? A bank reconciliation statement. Through a bank reconciliation statement. So let's check the cash book. Joseph Kahiga's cash book for month of December 2005 was as follows. This is the cash book. So check on the cash book. We have the debit side and we have the credit side. So ignore these ones. These ones are not part of the question there. Show you where to use them. So you find that the closing balance as at 31st of December was 179,300. So what does that tell you? If the closing balance was 179,300 and the closing balance here was 155,700, then this difference is what is going to necessitate the preparation of a bank reconciliation statement. So when you go to the required Joseph updated cash book as at 31st December, and 2, Joseph bank reconciliation statement as at 31st December 2005. So as you can see, we have to prepare bank reconciliation statement because the cash book and the bank statement balances are not the same. They are not the same. So let's go back. So let's start with step 1 of preparing. First thing, we are supposed to update the cash book. And how do we update the cash book? To update the cash book, you check those items that are in the bank statement and are missing in the cash book so that we can record them in the cash book. So what I'm going to do, I'm going to take the debit figures of the bank statement, then I'm going to compare them. These are the debit figures. Then I'm going to compare them with the credit figures of the cash book. And those figures that will be missing, I'm going to update in my cash book. So those figures, I've taken them. This is the debit figures of the bank statement. Then I'm comparing these with the credit side of the cash book. Remember, you said the debit side, the opposite happens. When you debit the cash book, on the other side, the bank will credit the bank statement. So I need to check if we have figures here that are not here, then I have to bring them here to update what? The cash book. So I start with this 24,300, I have it there. 17,400, I have it here. 1,700, I have it here. 3,200, 3,200 is missing, so I round that. 3,700, I have it, it is here. 9,500, it is there. 9,500 is here. 16,100, I have it here. 1,800, that is 1,800. You see it, 1,800, it is not there. Then 8,800, it is not there. 1,200, it is there. Then this was the closing figure. Then we have 2,500. 2,500 is there. So we have 3 figures here, this one here, that are in the bank statement but are missing in the cash book. So you need to check 3,200, 1,800, 8,800. What do they represent? So we have seen that this figure here is missing. This is a standing order. We also have this figure here, which bank charges, and this figure here, which is a direct debit. So those 3 figures, we are going to take them to the cash book. So we are going to update our cash book. So to update our cash book, we start by checking what is the closing balance in the cash book. So the closing balance is a credit closing balance. So we are going to have a balance brought down on the debit side because the balance carried down is on the credit side. So the balance brought down, or the balance brought forward, will be 179,300. That will be the opening balance in our cash book. So we have the opening balance 179,300. Then those figures that were missing, we had a standing order of 3,200, we put it there. 1,800, that was a bank charges. 8,800, that was a direct debit. So these were the figures that were on the debit side of the bank statement but were missing on the credit side of the cash book. So I have put them where they are supposed to be. They were supposed to be there. Then we compare the other side. The other side that we need to compare now is the credit side of the bank statement and the debit side of the cash book. So I need to carry these figures here. So I'm carrying the figures on the credit side. They're here. Then I'm going to compare these with the debit figures of the cash book, because these are credit figures in the bank statement. I can compare them with the credit figures, with the debit figures of the cash book. So we check for the items that are missing. 2,600, it is not there. So I have that one. 21,200 is there. Then 18,500, it is there. 11,800, it is there. 47,00, it is there. Then 27,900, it is there. So we only have one figure, which is 2,600. So if you check, 2,600 is here, which is a dividend. So this dividend is missing in the cash book. So we need to update our cash book. So you come here and bring your dividend of what? 2,600, which is here. That was the figure that was missing. Now, after identifying that, it is time now to update our cash book. So to update our cash book, we are going to include, this will be 179,300 plus 26 will give you 181,900. Then on the credit side, we have 3,200 plus 1,800 plus 8,800 to give you 13,800. Then to balance this account, we need to check the side that is lesser. This side is lesser. This is 13,800. This is 181,900. So the total figure here will be 181,900. So we need to carry down the difference. 181,900 minus 13,800. Whatever the balance is, 168,100. So that the total will now be, when you add these two, the total will be 181,900. So now, meaning our balance as per the updated cash book will be 168,100. That is one thing you need to identify. Balance as per updated cash book. And remember, it is the first item in the bank reconciliation statement. So when you're preparing the bank reconciliation statement, balance as per updated cash book is 168,100. That should be the first item, and we have it there. The next step, we need now to compare the bank statement and the cash book. We need to compare the cash book and the bank statement so that we can identify unpresented checks and the uncredited deposits. So let's start with the unpresented checks. And we said unpresented checks are those checks that you have written to your creditors, to your suppliers, but they have not been taken to the bank, or they have been taken to the bank but they have not been, the bank has not reduced funds, or they have not paid those particular checks. That means those checks are going to appear on your credit side of the cash book, but they will not be there on the debit side of the bank statement. So we are going to compare the credit side of the cash book with the debit side of the bank statement. So I'm going to carry these figures here. These are the figures on the credit side, and then I'm going to compare those figures with the debit side of the bank statement. So I have the credit figures here, then I'm going to compare them with the debit side of the bank statement. So if there is a figure that is here and it is missing here, it is an unpresented check. So we have 24,300, it is there. We have 30,700, which is there. We have 17,400, it is there. We have 1,700, it is there. We go to the next page, we have 9,500, sorry, we have 9500, which is there. We have 7100. 7100 is not there, right? 16100, it is there. We have 2500, it is here. We have 3700, the 700 is not there. 1200 is there. So we have these two here. So these two are unpresented checks. They are in the cash book but are missing. We are in the credit side of the cash book but are missing on the debit side of the bank statement. So these two, 7100 and that 700, we need to identify them from our cash book. So we have the two. Remember, we were comparing the credit side. So we have one, we have that 700, Steve Maitia, and we have 7100, which is Victor Karanja. So these two are going now to be our unpresented checks. So we go to our bank reconciliation statement. So unpresented checks, we are supposed to add them to this figure here. So we have these two. We don't have any errors, so this will be a dash. We get the total here. This is 7100 plus that 700, which is 10800, right? Then we proceed to the other side. Now we need to compare the debit side of the cash book and the credit side of the bank statement to check for what? Uncredited deposits. So I carry these figures here. I carry those figures. Then I need to compare them with the credit side. So I comparing, this is the debit side, sorry. I comparing the debit side of the cash book with the credit side of the bank statement. So 21,200, it is here. Then I have 11,800. We have it, 11,800. We are comparing with the credit side. This is the debit and credit. 11,800, it is there. 4,700 is there. 9,800, it is not there. Then 13,400, it is also not there. So these two are missing. So we have 9,800, 13,400. So 9,800 is here. That is Owen Dumbi. And we also have 13,400. So these two, the two of them will be what? Uncredited deposits. Uncredited deposits. So we come here, uncredited deposits. We have Owen Dumbi and Walter Oyugi. That is 9,800, 13,400. We don't have any errors in this question. We don't have any errors or transaction on the bank statement having an effect that will decrease the balance at bank. So you just put a dash there, get the total. 9,800 plus 13,400 will be 23,200. So again, now take this, add that, then you minus. We are minusing 23,200 to get 155,700. 155,700 here is the balance at bank as per the bank statement. Remember, the reason why we prepared the bank reconciliation statement, it was to explain the difference between the cash book and the bank statement balances. And because we have identified this is the closing balance, yeah, in the bank statement, and the reason why the cash book is showing a balance which is not the same as this is because these checks were not included and these checks were not included. There were also other errors. These transactions here were not included and this transaction here was not included. And that is why we have prepared a bank reconciliation statement that has explained why we had that difference. And therefore, this figure here of 155,700 should be the figure as per the closing figure as per your bank statement. So if you go back to the bank statement, the closing balance was 155,700, which is the same figure that we have gotten here after So that means when you're preparing the bank reconciliation statement, if you don't get the figure that your bank statement is showing, then you have not reconciled the two accounts. You must get a similar figure to ensure that you have actually reconciled. You have shown why there is a difference between the balance at bank and the balance at bank as per the cash book and the balance at bank as per the bank statement. This was Virtual Wisdom Finance and Accounting Tutorials. I hope this content was useful, and if it was useful, kindly don't forget to subscribe. Let your subscription count. That is the only way you can appreciate the good work that I'm doing. Kindly subscribe to the channel. Also click on the bell icon to be notified anytime I add new videos. Like the video, share with your friends, and leave a comment. If you have a question, you can drop it at the comment section and I'm going to respond to it as soon as possible. My name is Peter and I was your host in Virtual Wisdom Finance and Accounting Tutorials. Thank you for your time. Thank you once again. Bye.